So far we have spoken about individual choices, and we have seen that how choice making is important because there is limitation of resource. And then we said that okay, we can divide individuals in a society into two groups, that is buyers and sellers, and we have taken a look at the interaction of the buyers, that is the demanders, and the sellers, that is the suppliers, and we have seen how they can resolve their disagreements and eventually come to a point of agreement in the market, which is called the equilibrium of the market. Now, we kind of broaden our horizon a little bit. We kind of look beyond individual decision making, and we will try to look at the big picture for the economy, and we try to see that how important is decision making at the macro level, at the level of the economy. Is the economy also making decisions? Well, the answer is yes, and the economy is making decisions, and it is as much important as individual decision making. And in fact, there is an interlinkage between the decision making at the economy level and the decision making at the individual level. For example, sometimes we are not able to perceive how the economy is influencing our decision making. Nevertheless, there is a role of the bigger macroeconomy in our decision making. For example, let's say you are not getting a job, and so you may think that you are not trying hard enough, and so you are not getting a job. Well, while that might be true, the other reason that you are not getting a job could be because the economy is not doing well, and in general the number of jobs that are available is less, or the job creation rate in the economy is low. Similarly, if you want to have a startup business and you're trying hard, you're trying to get the finances, you're trying to get the loans for investment, and yet the business is not working, and even if you are able to kind of have a business, maybe it flops. While it could be because of your own individual characteristics, maybe because you did not have a great business idea to start with, but beyond that it could be something which is more macroeconomic, something like the economy is not congenial, it doesn't have a great environment for startup business. Maybe it's a very passive environment, a passive economic environment for new businesses to grow. So this means that your individual decision making and how your decisions fare in the long run have a linkage with what is happening in the economy as a whole. So it is not only important to understand individual decision making and how it is influenced by individual factors, but it is also important to understand how the macroeconomy can influence individual decision making, how it is important. So that is what we are going to do today. We are going to see how macroeconomic conditions are important and how they can affect individual decision making. But before we go on to that part, it is first important to understand that how do we know how the macroeconomy is doing? How do we assess the health of the macroeconomy? To assess that, for example, if I ask you what is your health status, if I had to know, well, I can ask you and you can say good, very good, excellent, or fair, or poor, or I can take some parameters. I can determine some parameters based on which I can decide really what is your health status. For example, I can measure your diabetes, your blood sugar level. I can measure whether you have high blood pressure. I can measure your cholesterol levels. I can check your pulse rate and stuff like that. So I could take some objective indicators and then decide what your health status is. Similarly, for the macroeconomy, we need some indicators to determine what is the health of the macroeconomy. And one such important indicator for macroeconomic condition is the gross domestic product. Gross domestic product, also called GDP. Now, GDP is basically it is the total amount, it is the total volume of all goods and services produced in an economy within the geographic boundaries during an accounting period, and that accounting period is usually 1 year. So the formal definition is, it is the total value of all final goods and services that are produced in an economy within its geographic boundaries, within the domestic borders during 1 year. Now, you can understand that this is a pretty prolific measure, because we are taking the value of all goods and services, and in an economy like United States, there are zillions and zillions of goods and services that are produced every year. So it's a very prolific measure. So before we understand, before we really go into how GDP is measured, and what are the things that go into GDP, what things should not get included into GDP, before we go into those technicalities, let us first understand this production process of the economy, how goods and services are produced, how the goods and services are exchanged, and how money is an important tool in an economy, how money kind of floats through an economy, and the flow of money determines the total national product or the total national income of an economy. So that is what we are going to do today. We are going to work through the process of production in an economy, and how goods and services are exchanged in an economy, and how money is used as a medium of exchange for goods and services, and how money flows through an economy and it determines the total national income or the total national product. So we will come back to the concept of GDP once we are through with that, but today we are going to focus on an economic model. We are going to focus on an economic model that basically tells us the flow of money or the accounting of the national income. So today we are talking about national income accounting. And once we are through with the national income accounting, it will become easier for us to understand the concept of GDP. Towards the end of today's class, I will actually relate these two concepts. I will tell you how national income accounting actually relates, takes you back to the concept of GDP. Now, to understand national income accounting, we will use an economic model which is called the four-sector circular flow model. So it's the four-sector circular flow model. The basic implicit assumptions in this model are, there are four sectors in the economy, and those four sectors of the economy are household, the government, the business firms, and finally the foreign sector. The foreign sector basically includes the rest of the world. So every other country other than the country that we are talking about would be in the foreign sector or rest of the world. So if you are talking about USA, if you are concerned about national income accounting for USA, then every other country except USA is basically a part of the foreign sector. Here we are talking about the households of USA. Here we are talking about the government. Now you know, in a country like USA, you have a decentralized form of government. So you have a federal government, you have state governments, you have local authorities. So here we are just making a simplifying assumption and putting them all together in the government sector, and then you have the business firms. So those are the four sectors of the model, and then you have three markets. The three markets are the goods and services market, the factor market, and finally the financial market. Now goods and services market are the market where any kind of commodities or services are sold. So that is the primary market. Now the factor market, the other word for factor is input. So factor market is basically the market where the inputs are bought and sold. Now in economics, we can group all inputs, we can group all resources. Now factors, input, resources, they are all synonymous, they mean the same thing. In economics, the resources or the factors can be grouped into four broad categories, that is land, labor, capital, and organization or entrepreneurship. Some textbooks will call this entrepreneurship. So land is basically the piece of land where you have to set up your business, the physical piece of land. Labor is the manpower that is needed in any production process. Capital refers to the machineries, equipments, warehouses, factory structures which are needed for a production process. And then organization or entrepreneurship talks about the managerial skill or the strategies that are involved in the production process. So those are the four categories for factors, and all factors can be grouped into one of can be put into one of those categories, and whenever those factors are used for production processes, some payments have to be made to the factor. For example, if I am using manpower, then I have to pay wages or salary to the workers. That is what I am talking about. If I am leasing out some equipments, if I am leasing out a factory space, then I need to pay rent for it. And if I am using strategic information or strategic skill, then that also needs to have a payment, which could be either in terms of wages or in terms of profits that accrue from the business. So the idea is that the factors are used and there has to be some payments made for using those factors. And then we have the financial market. Now financial market is actually a small subset of the goods and services market. So financial market is actually a goods and services market, but it is a very specialized case of the goods and services market, and so we are kind of treating it separately. It is specialized in the sense that only the financial goods and services are bought and sold in the financial market. So this only has financial products and financial services. So stocks, bonds and stuff like that, any brokerage services for trading in the stock market, all those go in the financial market. But please understand that this is actually a subset of the goods and services market. It's a special case of the goods and services market. Now in national income accounting, we are basically talking about how goods and services are exchanged in the economy, how goods and services are exchanged between the four sectors of the economy, and in return of the goods and services, how money actually flows between these four sectors of the economy. Now then, what is the purpose of these three markets? Now as money flows between the four sectors of the economy, they actually travel through the markets. So the markets are like pit stops, they are like hubs where the money actually comes in, and from there the money actually goes out into another sector. So money does not stay back in a market. The market is only a place of exchange for money. It is only like a pit stop, or maybe you can consider it to be like a transitionary spot for money where it kind of goes from one sector to another. So the source of money is one sector and the final destination is another sector, but the pit stop in between is a market. Now based on this information, let us actually look at how money flows between these sectors and through the markets. But remember, as we kind of walk through this model, remember that we are talking about essentially the flow of money. We are not talking about the flow of goods and services here, although whenever money flows, there is also goods and services flowing in the opposite direction. So what I am trying to say, if I buy, let's say a pen from you, then the pen, which is the good or the commodity, comes from you to me, and since I am buying it, whatever is the price of the pen, the money goes from me to you. So if I am just looking at the flow of money, then I am looking at the flow from myself to you, but there is also an opposite flow of the commodity, the pen, from you to me. So always there is an opposite flow of commodity, but we are not looking at the flow of commodity, although it is there. If you want, you could replicate my diagram showing the flow of goods and services, but what I am showing you in this video is the flow of money between the 4 sectors and through the 3 markets. Let's draw the 4 sectors of the economy. So that's the government, that's the household, I am just calling it HH, or the household sector. Then we have firms, and finally we have rest of the world or the foreign sector. And then we have 3 markets. So we have the goods and services market, we have the factor market, and we have the financial market. Okay. So those are the 3 markets that we have. Now, so the factor market, what is bought and sold in the factor market are the factors of production, which we just spoke about, the land, labor, capital and organization. Those are the things that are bought and sold in the factor market. The financial market, the stuff that are sold in the financial market are the financial products. So the stocks, bonds, any kind of brokerage services related to the financial products. And the goods and services market are pretty much every commodity and service that is produced in the economy is bought and sold in the goods and services market. Now let's start with the factor market. So what is sold in the factor market is the factors of production, that is land, labor, capital and organization. Now who are the factor owners? Who owns land? Who owns capital? Who owns labor? And who owns the managerial skill? Please reflect on that for a minute and see that we, basically the citizens of a country, we are the owners of factor. It is we who offer labor, it is we who are the landowners, it is we who own a space that could be rented out or sold out to a business owner. So basically it is the citizens or the people who live in the household sector, the people who live in the houses of America, they are the owners of factor. So if anything has to be sold in the factor market, these are the people who are selling those factors in the factor market. And who is buying those factors? The business firms. If you offer your labor for sale, a business firm has to buy your labor and then you get paid wages or salary for it. If you have a piece of land and you want to sell that piece of land, then a business owner buys that land for production purposes, right? So you are the owner of the factor and the business firm is basically the buyer of the factor. You are seller and the business firm is the buyer of the factors of production. So if we have to talk about the flow of money for the factors of production, then please understand that money is actually going from the firms into the factor market. Why? Because the firms are buying the factors of production. So money, they have to pay money since they are buying it, and that money is not staying in the factor market, but it is going from the factor market into the household sector, because like I told you, the owners of the factors of production are the people living in the household. So they are selling the factors, they are selling their labor, they are selling their land, and the firms are buying it. So the firms are paying that money and that money is actually traveling back to the households. Now, what is this money? This money is the factor payments that I was talking about a minute back. It is the money that is paid by the firms in lieu of the factors of production. So, basically this is this money is the wages or rent or profit, those things which are paid for the factors of production that the firms are paying, and this is going back to the household. So, when you sell your labor, you earn wages and you come back with the wages to your household. That is what we are talking about, right? So, all this taken together, if we considered all the households of America to be one unit, if we said that okay, there was this one big household sector in the country, then all the wages, all the rent and all the profit that came in to those households, whatever payments those households received would actually be the total income of the economy, right? And that income could be in different shapes, right? If you are a landowner and you leased out your land, then your income is in the form of rent. If you are a worker and you offered your labor and you earned an income, then that income is in form of wages. And if you are a entrepreneur, then your income is in the form of profits, right? So, nevertheless, whatever name you might want to give it, but if you consider the household sector to be one big macro unit, then the rent, the wages and the profits that you earn actually culminates, is actually aggregated as the income of the household sector and hence the income of the economy, right? Now, once you receive the income, the household sector receives the income, they can do three things to this income, right? What do they do to this income? First of all, you buy your groceries, you pay for your utilities and all of that, right? So, you are buying some goods and services. When you buy your groceries, those are commodities. When you buy utilities, you pay for your phone bill, those are you are basically paying for services. So, you are actually buying goods and services, and whenever you are buying goods and services, money is actually, you have to pay money. So, you are paying to the goods and services market and you are getting your milk and your groceries and your utilities and all that in return. So, you are buying, right? This spending by the households on the goods and services market, this flow of money, the households are buying, so they have to pay money. This spending is known as consumption spending and it is denoted by a capital C. So, consumption spending is the money spent by the households on buying goods and services in the goods and services market, right? Now, where does this money go? Like I said, no money stays back in the goods, no money stays back in any market. It flows from one sector to another. So, this money that the households are spending on goods and services, where does this go? Now, who is producing these goods and services and who is selling these goods and services? Obviously, the business firms, isn't it? If you go and buy a loaf of bread, then the money that you pay to the for the loaf of bread goes to Walmart and eventually it gets trickled down to the other smaller production units like to a bakery and to the farmer who produce the wheat or the corn and all of that. So, there is a trickle down effect that takes place, but the central idea is that the money that you pay for goods and services does not stay back in the goods and services market, but it goes to the firm sector because they are the people who are actually selling the goods and services. They are supplying the goods and services to this market. So, whatever money is accumulated by selling those goods and services actually goes to them, right? Very easy concept, right? If you have difficulty understanding this, think of it in a smaller sense. If this is the apples market, the households are buying the apples. So, this is not staying back in the market, the money is not staying back in the market, it is going to the people who supplied the apples. So, that is what we are talking about here, okay. Now, so the consumption spending goes to the firms actually through the goods and services market. Now, the firms, please understand that their firms also have to buy goods and services. The firms have to buy goods and services because you cannot produce something out of thin air. To produce something, you need something else. For example, if I want to make apple sauce, then I need some raw materials for making that apple sauce. I probably need apples, and I need water, and I need, maybe if I want to add a little bit of cinnamon powder, I'll need that. So those are also goods and services. In other words, to produce any output, to produce any final commodity, you need some inputs or some resources, and those resources are also other goods and services. So the firms also have to buy goods and services. So there is also a flow of money from the firms into the goods and services market, right? They are also spending on goods and services. But please note, there's a difference between this spending and that spending. Here, the households are paying for the goods and services because they want to consume those goods and services. You buy apples because you want to eat those apples for breakfast. If a firm is buying apples, they probably want to make apple juice, which is their product, or apple sauce, which is their product, right? So there's a difference between these two spending, and hence we have to give a different name to it. This is called investment spending, because this spending is for the business purpose, for investing into the business. So it's called investment spending, which is denoted by a capital I, right? So consumption spending is the spending of the household sector on goods and services, whereas investment spending is the spending of the business firms on the goods and services market. Okay. Now, once again, let's go back to the household sector. We had said that income came to the household sector, and they spent a part of that income on their groceries and on utilities, which is basically their consumption spending. But also note that they also need to pay some taxes out of their gross income. Before they even go and spend on utilities and groceries, they have to pay taxes to the government. So a part of their gross income goes to the government. There is a flow of money from the households to the government, and that is basically the taxes, right? So once they have paid taxes, and once they have bought groceries, utilities and other things that they need, then there is a leftover portion, which is basically the savings of the household. So you earn $100, you pay $10 in taxes, you have $90. Out of the 90, you pay 50 for your basic needs, right? Your groceries, utilities, your rent or whatever, and then you have $40 left over, which is basically your savings. And you do not stack your savings under your pillow, but you invest your savings somewhere. You either put it in a savings account, or you keep it in a bank account, or you buy a certificate deposit, or you buy a stock or a bond of a company. So basically, you are buying a financial product, or you are investing your savings in a financial product. So that means your savings are actually going into the financial market, because you are investing your savings in a financial product. So this flow of money is basically the savings of the household, and the savings of the household is also known as private savings. Private savings, and it is denoted by S with the suffix P. So it's private savings. So now, so the households have sold their factors of production. They have received their income in the form of wages, rent and profit. From that income, one part is spent on goods and services, groceries, utilities, etc. One part is paid in taxes to the government, and the remaining, which is the savings of the household sector or private savings, gets invested in the financial products in the financial market, right? Okay. Now, let's kind of look at the government sector. We haven't spoken about the government sector at all. So the government sector also must earn income, right? Because if you have to spend, you must earn the money from somewhere. So we can already see that this is basically the source of earning or the source of income for the government sector, the taxes that they receive from the households. And of course, firms also pay a little bit of taxes to the government, the business taxes. So there is also, you know, something going from the firms to the government. Let's not make the picture too much cluttered, so we'll leave that because it's a small. The income taxes that the government receive from the household sector is the major chunk. So the government receives taxes, and that is the source of income for the government. Now once again, from its own income, the government spends, and the government spends definitely on goods and services. The government buys goods and services. So government has to pay for those goods and services. There is money coming from the government into the goods and services market, right, and eventually going to the firms like we have there, because the firms are selling those goods and services. Now why do government need to buy goods and services? Government needs to buy goods and services because it has to run the country. It has to build bridges, it has to build roads, it has to pay for defense weapons. So all those are actually goods and services produced in the economy, and those are bought by the government. So we are talking about those goods and services which are being bought, and hence the government has to spend money in buying them, and this part is also known as government spending, and it is denoted by a capital G. So the government is buying goods and services, the goods and services are going from the market to the government, and the government is paying in return, and that money is eventually going to the firms, because it is the firms who have supplied those goods and services in the first place. So it doesn't stay back in the market, it goes back to the firms, and out of that money the firms are buying the factors of production, they are paying wages, rent and profit, and they are paying a part of taxes to the government, right. So that you can see why the name circular flow, because each time we talk about one flow, you always establish it's not unidirectional, there is always like a circular flow going on between the sectors through the markets. Okay. Now the government has made some income through taxes, it has spent on goods and services. Now the government could also technically have some leftover or some extra income, just like the households. The governments may also have some savings, right. So where does the government put its savings? The government also puts its savings into the financial market. The government also invests in stocks and bonds. So there is a flow of money that is coming from the government into the financial market, because the government is also putting its savings or investing its savings into the financial market, right. So this part is the government savings, also called public savings, and it is denoted by S suffix G, G for government, right. So you can see two kinds of savings. One savings which is the household savings or the private savings, and the other savings is the government savings or the public savings that is going into the financial market. So they are putting their money into the financial market, and in return buying some financial products which is going to them. But where did these financial products come in the first place, right? These stocks and bonds, where did those come in the first place? Someone had to issue those stocks and bonds, right, in the market. So it has been issued by the firms. For example, let's say I earn $100, right, that's my income. So I have earned those $100 by offering my labor, excuse me, by selling my labor to Missouri State University, right. So I have sold my labor and I have earned those wages. So wages have gone into my household, the $100. Now out of those $100, I have spent $30 on goods and services. I have paid $20 as taxes to the federal and the state government. So I have another $50 left over. $30 is my C, $20 is my T or taxes, and I have another $50 left over, and I decided to invest those $50 in a financial product, let's say the stocks of Amazon. I have bought a stock of Amazon and invested my savings into it. So basically I am buying the stock of Amazon that is coming to me, and I have put my money, my remaining $50 savings into there. But where did the stock of Amazon come from? In the financial market. Someone had to sell, or someone had to create that stock in the financial market, or supply that stock in the financial market. Obviously the business firms, because Amazon is a business firm, right. So that has been actually issued in the financial market by the business firms. And why did the business firm actually issue this stock? What was the purpose? Because they needed to raise money for their business purposes. That is the reason that business firms go and sell their stocks, because every time they sell a stock, it is like, okay, I am selling this stock to you, give me money in return, they will take that money and go and invest in their business. So stocks are a way in which the business firms are basically raising money from the rest of the sectors to invest it in their own businesses, right? So they are sending the stocks here, but whenever the stocks are getting sold, that money is going back to them because they want to invest it. And please note that that money which is going to them is not a permanent money, that's a kind of borrowing they are doing, right? So if I am buying a stock of Amazon for $50, that $50 is going to Amazon, but tomorrow if I sell off my Amazon stock, Amazon needs to pay that $50 back to me, or whatever is the market value of the stock tomorrow, they have to pay that money back to me. So it's not with them forever. They are raising that money from me, they are borrowing that money from me to invest in their business, but they need to return it. So this is basically that money is going, but it is a kind of borrowing. We call that private borrowing. Private borrowing. So the savings of the households and the government, which has been invested in the financial market, in financial products, stocks, bonds, etc., actually goes to the private sector, to the business firms in the form of private borrowing. Okay. Now think about another thing. So in the government sector, they earn taxes, that is their source of income, and they have to buy goods and services, right, to provide for the different sectors of the economy like public infrastructure and defense and education and all of that, and they have some leftover which they are putting in the financial market. But besides buying goods and services, the government also has to spend on some other kind of activities. For example, welfare payments. The government has to pay for food stamps, it has to pay for public health insurance, it has to pay for the WIC program, they have to pay for social security, pensions, so on and so forth, disability insurance, unemployment benefits. So those are also things that the government has to pay for. Now that kind of payment, it is not like buying a goods or service. If the government is paying you for social security, an elderly person, then that person is not giving a good or a service in return. It's a one-way payment. There's a difference between this and that kind of payment. Here the government is buying defense weapons, so it's paying money, but the weapons are going to the government, right, which the government is going to give to the military. But if you think about social security, then the government is making the payment, but nothing is coming back in return, correct? So those kind of payments are also known as transfer payments, and the households usually receive those transfer payments from the government. So that's also a source of spending for the government, right? So when the government earns money, that is taxes, it spends on goods and services, and it also spends on transfer payments, which is basically welfare, social security, pensions and stuff like that, and the rest, the remaining leftover, it invests in financial products, which is basically the public saving. Now please be sure that you understand the difference between transfers and the government spending on goods and services. There is a basic difference between capital G and transfers. Transfers are not included in capital G, right? Capital G is only the spending on goods and services. So money is going out from the government and the goods and services are coming in. It's a bi-directional flow. There's a two-way flow. But for transfer payments, it's only the government paying and nothing is coming back in return. For example, food stamps. A family receives food stamps from the government, does not give anything back to the government in return, or any kind of welfare payment for that matter, unemployment benefit. Government is giving the benefit, but you are not working for the government or you are not contributing to the economy in any way right now. It's just a one-directional flow. So please be very careful about kind of understanding the difference between these two. Although both are sources of spending, they are not similar kind of spending. This is two-way. The spending is done and the goods and services come in. This is only a one-directional flow. It's only about the spending. Okay, nothing is going back in return. Now let's concentrate a little bit here, because we haven't touched the foreign sector and we have just touched the financial market a little bit. What is the linkage between the foreign sector and the rest of the economy? Now, as you know, in today's world, in an open economy where every country trades with other country, then the foreigners are also buying our goods and services, right? Goods and services are going from America to the rest of the world. Sitting in India, I could buy a commodity that is made in USA, right? I don't have to come to America to buy that good. I can sit in my own country and buy a commodity that is made in United States. How can I buy it? Because those goods and services travel to my country, right? So basically, those are the exports that went from United States to India. The goods traveled from USA to India, but the Indians are buying it, so the money is coming from India to United States. So that means there is a flow of money that comes from foreign countries to USA, and that money comes because these foreigners sitting in their own countries in the rest of the world are buying the goods and services that were produced in the goods and services market of United States. And how were they able to buy it? They were able to buy it because those goods were exported from here to those countries. So basically, this payment is the payment that is made for exports, right? Now you can tell me that why export means things are going from USA to the rest of the world, then why is the direction of the arrow this way? Reminding you once again that these arrows are showing the flow of money and not the flow of goods, right? The goods are going from USA to the foreign countries, but the money is coming from the foreigners back to United States into the goods and services market and going to the business firms of USA, whoever made those goods, correct? So then if that is true, then also sitting in United States, I can also buy goods and services that were made elsewhere, right? If you go into Walmart, you see goods that were made in Indonesia, goods made in Vietnam, Bangladesh, so on and so forth. Now you don't have to go to those countries to actually buy the goods that were made by them. You can sit in your own country in United States and buy those goods. You can do that because those goods actually travel to your country. They were imported to your country. So the goods came from those countries to USA. You are buying those goods. So the money is actually going from you, goods and services market, back to those foreign countries. So that's the flow of money, not the flow of goods. You are buying the goods, so the goods must have come from the rest of the world to your market, but you are buying it, so the money is going in that direction. And this is the money that you are paying for the imported goods. So that's the payment for imports. Okay. Now similarly, there is also exchange of money between the rest of the world and our own financial market, right? The financial market of USA. Why? Because people sitting in the rest of the world could be putting their money in the financial market of USA. They could be buying stocks of US companies, and sitting in USA, I could be buying stocks of companies elsewhere in Mexico, in India, in Japan, of those companies, right? So there is also exchange of money going on there. Now if some Indian company or some Japanese company or some Korean company is selling their stocks in the US market and the citizens of United States are buying those stocks, then basically these people are borrowing money from us. The Japanese and the Koreans and the Indian companies are actually raising money in the US stock market. So when money flows from the US stock market to those countries, right, those countries are borrowing from you, because tomorrow if you go and sell off your stock, then that Japanese company has to pay your money back, right? So that is foreign borrowing. Foreign borrowing. A foreign company selling its stocks in the US market and raising money, right? Similarly, a US company could be selling its stock in the Indian stock market or in the Japanese stock market and raising money from the Japanese and the Indian people, isn't it? So that means it is the rest of the world that is lending money to USA. So money is coming from the rest of the world because people in those countries are buying stocks of the US company. So that's foreign lending. They are lending money to us. If they sell their stocks off tomorrow, we have to pay the money back to them. So that's foreign lending, right? So that kind of completes this circular flow diagram. If you look at it for a minute, you can see that every time the money originates in a factor, in a sector, and it goes to another sector and it travels through a certain market. Now the important thing to note here, please remember, is that we are always looking at the flow of money and we are not looking at the flow of goods and services, although there is an opposite flow of goods and services involved in every case, right? For example, here, if the households are paying money on goods and services are going back to them, right? If firms are investing on goods and services are going back to them. So there is always an opposite flow. Now, like I said, how does this diagram kind of give us the concept of GDP, or the total volume of goods and services that are produced in this country? Please understand that the definition of GDP that I started with is, it says that it is the total volume of all goods and services that are produced within the geographic boundaries of this country within 1 year. So if you draw this diagram for one particular year, then all the goods and services that are bought and sold in this market are basically the goods and services that are produced in this country during this year. Now please remember, now in this market they are not only selling the goods and services that were produced in USA, but they are also selling the goods and services that came from rest of the world to the US market. So you have not only goods made in USA, but you also have goods made in Vietnam, Indonesia, Bangladesh and India that are being sold here. So you have to be careful. This has the total volume of all goods and services sold in USA, but it is not essentially the total volume of all goods and services that were made in USA, right? But GDP is about, it is about the goods and services that are produced within the borders of this country. So it has to be made on US soil to get, so for you to get GDP. So from this diagram, if I try to get the concept of GDP, or gross domestic product, then the easiest way to do that would be to account for all domestic made goods and services that are sold in this country. So let me add what are the money, how much money was spent on the domestic goods and services. So households bought the goods and services, so they spent $100, so obviously that goes in C. The government bought some goods and services, so obviously that goes in G. The firms bought some goods and services, so that goes in capital I. The foreigners also bought some goods and services from us, the others sitting in their own countries, they bought the goods made in USA, those goods were made here. So obviously whatever was exported, now export is written as capital X, so exports are included. But please note that households have also bought some goods that were made in Japan or India. Government has also bought some goods and services that were made in the rest of the world, and so have the firms. So that means this C, G and I also includes spending on goods that were not produced here. So that must be taken out from this equation, right? So we take out the imports, and imports are denoted by a capital M. So the equation becomes C plus I plus G plus X minus M. That is the equation for the GDP, and that is how this diagram relates to the concept of GDP. Now I will elaborate more on this in the next lecture, but for today it is important for you to understand why we are coming up with this equation. Once again, I want to reiterate that the definition of GDP is, it is the total volume of all goods and services produced within the geographic boundaries of the country during 1 year. So the geographic boundary, within geographic boundary, that part is important, and all goods and services, that part is also important, right? So all goods and services are sold here, right? But some of those goods and services are made in USA, but some are also made in other countries but sold in USA, isn't it? And who is buying them? the households are buying them, the firms are buying them, the government is buying them, and the rest of the world is buying those goods and the services. So if we kind of accumulate all the money that is spent by these people, these sectors, then we should be able to get the value of those goods and services, isn't it? Let's say I am selling some pencils and some pens, and I want to find out what is the value of all the goods that I have produced and I have sold. What can I do? I can just go to the people who have bought my goods and I can ask them, how much have you spent, how much have you spent, and how much have you spent on my pens and pencils, and if they give me their numbers, I can add those numbers up and say, okay, this is the value of my sales, or this is the value of my production that was sold to these buyers. That is exactly what we are doing. We are adding up the spending of the buyers, and here the buyers are the four sectors of the economy. So the consumption spending, the government spending, the investment spending, and the exports are the spending of the foreigners on our goods, the goods that were made in USA, how much the foreigners have spent on it, foreigners sitting in a foreign country. But we also need to take out the imports. That needs to be subtracted, because these buyers, the households, the governments, and the business firms, they have not only bought the goods made in USA, but they have also ended up buying some foreign made goods. So that cannot go into GDP. Goods that were produced outside the geographic boundaries cannot get into GDP. Goods that have traveled from elsewhere cannot get into GDP. So that needs to be excluded out. So we are doing minus imports. Okay. Now this formula can also be rewritten or reorganized as GDP is equal to C plus I plus G plus NX, where NX is nothing but X minus M, right. So that NX is nothing but this part, the X minus M, and NX basically stands for net exports. NX stands for net exports. Okay, so that's just another way of reorganizing and writing that formula. So today we have covered the flow of money and the accounting of income and production within an economy and how that relates to the GDP. When we come back next time, I am going to start from here. I am going to start talking about the concept of GDP, the methods of measuring GDP, what goes into the GDP, and what should remain out of the GDP. Okay, thank you.